Welcome back to the deep dive. Today, we're jumping into the latest financials from Restaurant Brands Asia Limited. The company running Burger King in India and also Burger King and Popeyes over in Indonesia. They just dropped their Q1 FY26 numbers for the quarter ending June 30th, 2025.
Yeah, and it's a really interesting set of results. Gives us a good window into how a major QSR chain is, well, handling things in a pretty dynamic market.
Yeah.
So our mission today really is to unpack their strategy, make sense of the numbers, and maybe pull out some broader lessons, about innovation and operations today.
Exactly. So if you're curious about balancing that aggressive growth with digital stuff and, of course, profitability in the fast food world, well, you're in the right place. Let's get into it. See what RBA has been cooking up.
Okay, let's start with India then. What really jumped out at you from this latest quarter, I saw the revenue from operations was INR 5,523 million. That's up, 12.6% year over year. Solid.
Solid indeed.
But the thing that really caught my eye was the same store sales growth, 2.6%, apparently driven by over 6% growth in just dine-in traffic. Yeah, that dine-in number is quite something.
Plus, they added 63 new stores in the last year. That brings them up to 519 total now.
Right. And underneath those headline numbers, you really see this push for profitability. Their restaurant EBITDA, that's before the IND AS 116 lease accounting, mind you, improved. It was up 0.8 percentage points year over year,
Okay.
reaching INR 536 million. That's a 23% jump. And like you said, it's not just sales volume bumping it up. It feels very much like strategic execution.
Okay, strategic execution. You hear them talk about this barbell strategy. That sounds, well, interesting. How does that actually work for them?
It's a great question. And it's pretty clever, actually. So on one end of the barbell, they're really doubling down on value. You've got these 2 for 79 and 2 for 99 deals that have been running for over a year, right? And they just keep pulling people in.
Persistent traffic drivers, yeah.
Exactly. And they even did this INR 99 cafe promotion for 4 weeks over the summer. They said it delivered stellar numbers, got more people trying their coffee and shakes. And what's really key here, I think, is that this strategy isn't just for restaurants. You see this playbook in lots of businesses when the market tightens up. Serving both the value hunters and the premium crowd, that builds resilience.
Right, so they've got the value end covered. What about the other end, the premium stuff?
Oh, yeah, they're definitely working that angle, too.
Yeah.
They just relaunched their King's Collection 2.0.
Yeah.
Upgraded burgers like brioche buns, better patties, all based on, what customers were telling them in research.
Okay, responding to feedback.
Precisely. And then they had this Korean range as a limited time offer. That was quite interesting. Sold for over 200 rupees. Got a fabulous response, apparently. And the taste tests, 95% purchase intent, 98% authentic Korean flavor. Pretty specific numbers.
Wow, yeah.
So the plan is to rotate these kinds of LTOs every quarter.
Yeah.
And this whole dual approach, it's super important right now because they did note that the premium end of the market overall is seeing tighter demand. The average spend per customer, the APC, has actually been declining across the industry.
Interesting context. So it's not just what they serve, but how, especially with digital. You mentioned the pace. It sounds incredibly fast.
It really is. Think about this. 93% of their restaurants now have self-ordering kiosks.
93%.
Yep. And they rolled that out in just over 2 years. Plus, 100% have table ordering and app ordering.
That's comprehensive. So what's the actual effect of going that digital that fast?
Well, it points to something bigger, right? For any company, digital isn't just about convenience anymore. It's about data. It's building the foundation for, future AI across everything, customer interactions, staff tools, even vendor stuff.
Right, the data angle.
And for RBA, get this, a massive 90% of their sales now come through digital platforms.
90%.
Yeah. And their BK app is a real loyalty driver. They're seeing 80, 90 transactions a day just from repeat app users. App installs jumped 50% quarter on quarter, orders up 60%. The engagement is clearly there.
So, okay, great digital numbers, but how did all this, the barbell, the digital push, how did it actually help the bottom line, the profitability?
Good question. Well, first, delivery got more profitable. Margins went up by 1 percentage point there, while delivery revenue still grew, 11, 12%.
Okay, that's significant.
Definitely. And then they found serious cost savings in the middle of the P&L. Utilities, renegotiating IT contracts, things like that. Those savings flowed directly into that better restaurant EBITDA margin we talked about.
Makes sense.
And zooming out a bit, they're playing the long game on costs too, like signing new rent deals that are way below the ones from years ago. That'll slowly bring down their overall rent costs over time. They even deliberately spent a bit more on labor, this quarter
Oh, why is that?
for training. Getting staff up to speed on all the new digital tools and the menu changes. The bet is that this investment now means lower labor costs later as sales grow and people get efficient with the tech. So even though it's a tighter market, limited demand, especially for premium stuff, that focus on value plus efficiency is keeping them pretty solid.
Okay, India sounds strong, but let's pivot to Indonesia. That's been a big focus for their turnaround efforts, right? They talked about three things: boosting sales, rationalizing stores, and cutting corporate overheads. How's that going?
It seems to be progressing, yeah. They're definitely seeing some positive signs. In the Burger King Indonesia business specifically, average daily sales, or ADS, were higher for 8 of the last 9 months. That's from November 24 through July 25.
8 out of 9. Okay.
Yeah, which led to about 5% year-over-year ADS growth for that whole period.
Ah,
And here's the really big news. The Burger King restaurant business itself actually made money this quarter at the restaurant level. That's the first time in quite a few quarters.
wow. Okay. That is a milestone. How'd they manage that?
Well, they started with the basics, fixing product quality based on what customers were saying in surveys, then new products, things tailored more locally, spicy variants, cheesy options for both burgers and chicken. That apparently brought high volumes of people coming back.
Ah, localization paying off.
Seems like it. And they've got more coming. There's this Ayam Nusantara, a whole chicken thing with local spices launching next month. And after that, a more Western-style breaded whole chicken. So more innovation on the menu.
Okay. What about the stores and costs?
Operationally, they closed another 4 Burger King stores this quarter that weren't performing well. That's on top of 8 last year. They're signaling that they're nearing the end of that rationalization journey for the store footprint. At the same time, they're constantly trying to renegotiate rents down.
Right. Chipping away at costs.
Exactly. And the corporate overhead reduction. Also pretty impressive. They've already cut 25%. That's INR 15 crores or 150 million rupees over 2 years.
Okay.
And they reckon they're on track for another 10% cut this fiscal year, which is about INR 4.5 crores or 45 million rupees. The goal is to eventually cut those overheads by a full third from where they started.
That's a significant chunk. Now, what about Popeyes in Indonesia? That's the other brand they have there.
Right, Popeyes. It's a different story there. They had 25 stores. But Indonesia is a very competitive market for fried chicken. Super crowded.
Yeah, I can imagine. So how do you even compete in a space like that?
Well, that's the question they seem to be asking. They've decided to kind of pivot the strategy for Popeyes. They want to lean into being a chicken destination, but offer a more elevated guest experience. Something closer to fast casual, maybe?
Okay. Elevating it.
Yeah, while still keeping that digital-first approach they have everywhere else. They tested this in a couple of stores, saw some early positive signs, more dine-in business, better gross margins. So now they've rolled it out to 4 more stores. There are still challenges, though. Popeyes ADS actually fell a bit, from 14.6 million down to 13.2 million rupees. But the focus really seems to be on finding a path to sustainable profit, not just chasing sales growth right now.
Okay, so putting it all together then, India and Indonesia, what does the overall consolidated picture look like for Restaurant Brands Asia?
Well, the combined revenue from operations hit INR 6,977 million. That's up 7.9% year-over-year overall. And their consolidated company EBITDA, again pre-INDS 116, grew a pretty impressive 37.4% year-over-year, landing at INR 119 million.
Okay, so solid growth on both top and bottom lines consolidated.
Yeah, it really reflects that strategic work they're doing in both places kind of coming together.
Yeah.
And the guidance for India hasn't changed. They're still planning for 60 to 80 new restaurants a year, with a target of getting to around 800 restaurants by FY29. And they're also aiming for a gross profit margin of roughly 70% by then, up from about 67.7% this quarter.
Ambitious targets. It's good to see that forward planning. Did they say much about the money they raised? That QIP, the Qualified Institutional Placement?
They did, yeah. They raised INR 5,000 million, or 500 crores. A good chunk went to paying down debt early, funding the new restaurants and any capex, basically, and just general corporate stuff. But they still have a substantial balance left, over INR 3,133 million, just sitting in fixed deposits and mutual funds. And that actually explains why their other income saw a noticeable jump this quarter. It's the interest from that cash pile.
Ah, okay. Makes sense.
So, summing it up, the management commentary keeps hitting these notes. Innovation along with operational excellence. That seems to be their mantra for navigating this dynamic environment. They sound pretty confident they can keep balancing sales growth with margin improvements, using both the menu innovation and that tight cost control.
What a deep dive that was. It really feels like Restaurant Brands Asia isn't just, opening more stores. They're actively refining how they do business, driving growth with that smart barbell strategy, pushing digital incredibly fast, and all while watching every single rupee, it seems.
Absolutely. And you can see the results, right? Not just in India's solid numbers, but also those promising green shoots in the Indonesia turnaround.
Yeah.
They clearly get that when consumer spending tightens, you need both compelling value and those attractive premium options, and you've got to make every operation super efficient, make every dollar count.
Totally agree. So, as we wrap up, maybe a final thought for you, the listener. In this kind of world, right, where wallets are tighter, digital convenience is king, how do companies like RBA keep reinventing that fast food experience? How do they capture both the bargain hunters and the people willing to pay more while still delivering profits? What do you think their next big play might be? Lots to think about there. Thanks for joining us for this deep dive. We'll catch you next time.